I don't want to eat any more garbage banks.
Kevin O'Leary on what's wrong in 2024. These big banks are doomed to fail. The Shark Tank judge, Kevin O'Leary, had some heavy words to say about the U.S. economy crisis. Is this a sign that we are on the verge of an economic storm? There's a massive $1.4 trillion problem hanging over the U.S. commercial real estate market like a looming financial earthquake. What makes it scarier is that a whopping $1.5 trillion of this debt is due before the end of 2025. Believe it or not, it will affect the U.S. economy too, especially the working class. As interest rates increase, a ground-shaking correction in real estate looms large, casting a dark shadow over the financial world in the United States. What's going on? Today, not only will we be talking about the current conditions of the housing market, but also the U.S. economy and the political landscape currently that can drive the United States into the red zone of recession. How can you tackle this recession? Stay tuned to know how. Times like these are scary, especially with how big of an impact they can have. But hey, don't worry. Just subscribe to our channel and we will keep you in check with the most up-to-date movements in the U.S. economy. Beyond housing market, the U.S. economy. On the other hand, the U.S. economy stands at a critical point where a debate regarding the ghost of recession has unfolded among politicians, economists, and financial professionals, which drastically affects the lives of you and I. While the typical definition of a recession is 2 consecutive quarters of negative gross domestic product or GDP, which showed up in the first half of 2022, the National Bureau of Economic Research has another opinion. According to the NBER, a recession says that it is a significant and protracted decline in economic activity across various sectors. By this measure, the U.S. was not in a recession in 2022, and the current assessment maintains this stance. This is at least what they tell us. The Federal Reserve, which was originally determined to increase interest rates until inflation went down a lot, has changed its plan. Because the economy is slowing down and Silicon Valley Bank, the second biggest bank failure in U.S. history, collapsed, the Fed is thinking about stopping the rate hikes. It will surely affect even an average U.S. citizen. This matters for regular people because when banks fail, it can make it harder to borrow money, affecting things like loans for homes or cars. It can also make it more difficult for businesses to grow, potentially leading to job losses or economic uncertainty for everyday citizens. This could even lead to a situation where it's tough for regular people to get small loans, whether it's for buying a home or starting a small business. And let's not forget that interest rates, the key economic lever, are tied to the housing market. A crisis could make the Federal Reserve rethink its take on interest rate hikes, impacting broader economic conditions. If the Fed shifts towards a more accommodative monetary policy, it could influence borrowing costs, consumer spending, and business investment. It just doesn't end here though. Inflation, another critical economic element, is influenced by housing-related factors. The potential fall in property valuations may ease inflationary pressures, but the broader economic consequences such as job losses and reduced consumer spending could counterbalance this effect. This shows how almost anything happening on a governmental level can affect each individual. The problem: skin without soul. The main issue is that these buildings are pretty much empty and don't have much value left. They're running on empty both literally and figuratively. The impending challenge: when the time comes to refinance, the road ahead may be tough, leaving void structures, but no soul or workforce. For an average U.S. citizen, this narrative takes a personal turn, a cornerstone of the community, grappling with the aftershocks. O'Leary's revelation says around 40% of these banks' financial stakes are entangled with these uncertain structures. A housing crisis could also lead to a downturn in construction and related sectors, again resulting in job losses. Yes, the same job losses which have already stressed the upcoming youth to this extent. But question is, who is to blame for this? Biden's mismanagement in U.S. and his decision-making, a hot take. There's a clear conclusion that something terribly wrong is happening with management of economy on broader scale. It could be seen as Biden's leadership faces a stark reality painted by disapproving statistics. With an approval rating of just 38% and a disapproval rate roaring to 54%, his standing is notably worse than most of the previous presidents. Biden's governance and his handling of the economy is a sore point, as only 37% of Americans approve, while a significant 58% express dissatisfaction. The skepticism extends to the notion of Biden running for re-election, with a staggering 70% of Americans signaling that they do not want him to return to power. These figures paint a picture of a presidency grappling with severe public disillusionment. Criticism doesn't stop at policy disagreements. It dives into personal attributes. Biden's age, appearance, and presence have become talking points, feeding into a narrative of a leader who might not be physically or mentally fit for the job. This emphasis on personal characteristics raises doubts about his effectiveness in making critical decisions for the nation. The hyper-partisan landscape is evident, with only 4% approval from Republican voters, underscoring a deep and wide political divide that may hinder any bipartisan efforts. Now, you may ask why we are targeting Biden in a U.S. economy crisis video. While the GDP growth in the United States outpaces other industrialized nations, questions linger about the direct impact of Biden's policies on the average citizen's well-being. Inflation rates, though peaking earlier and falling sooner in the U.S. compared to other G7 countries, have hit crucial sectors like supermarkets and gas stations, raising concerns about the effectiveness of economic strategies. With an already outstanding $33 trillion, the huge chunk addition of $1.9 trillion to the national debt by 2031, projected under the American Rescue Plan, shows the ill effect on the long-term consequences and the burden it may place on future generations. Stay tuned in the video, because what comes ahead is not just a problem for Biden or his presidency, it's a problem for every individual in the United States. The debt that is just an avalanche going down the mountain. $1.4 trillion debt-fueled threat. The looming $1.4 trillion threat hanging over the U.S. commercial real estate market is nothing short of staggering, setting the stage for a potential finance earthquake. With a substantial portion of this debt, $1.5 trillion, coming due before the end of 2025, the urgency of refinancing risks is on doorstep. Morgan Stanley analysts are suggesting that the maturity wall is not only sizable, but front-loaded, intensifying associated risks. The situation is intensified even more when we talk about rising interest rates and defaults, which have already taken a toll on commercial mortgage-backed securities deals, witnessing an 80% drop in sales without government backing in the first quarter. As the amount of money that needs to be paid back goes up in the next 4 years, reaching the highest point at $550 billion in 2027, things get more stressful. But what do experts think of the current situation? If we talk about recession, there's only one household name that comes to mind: legendary Michael Burry. Michael Burry's concern. Is the foundation of the U.S. economy really built on shaky ground? How credible is Burry recently? Even back in June 2022, prices were going up, but Burry said they'd slow down by the end of the year. People thought he was being a bit strange, but in December 2022, prices did slow down to 6.5%. Now, in the new year, Burry's back on Twitter, saying prices are still going down. And surprise, surprise, in May, they're at 4%. Burry also said some big money problems might happen, like a crash and a tough time for jobs called a recession, especially when the warning comes from someone who is a veteran at guessing markets. Some of what the Scion Asset Management chief predicted hasn't happened yet. He said there would be a huge crash in the stock market, but it didn't go as low as he thought. He also said that American families would run out of savings by the end of the year because prices were going up and borrowing money was getting expensive. He warned this could make people spend less and hurt businesses. In January, he said the U.S. would probably go into a recession, making the government and the Federal Reserve do things to boost the economy. But these predictions are still about to unfold. Buffett and Burry's parallel opinions. It's not just Burry who has this concern. The legendary investor Warren Buffett shares the same concern too. Warren Buffett sent shockwaves through financial markets with his recent bearish move, and economist Steve Hank believes they might be gearing up for challenging times ahead. In the last quarter, Buffett's Berkshire Hathaway made significant moves, selling a net $8 billion of stocks and slowing down its buybacks. This strategic shift resulted in a remarkable 13% increase in its cash reserves, reaching a near-record $157 billion. Over the past 3 quarters, Berkshire has offloaded a net $33 billion in stocks, leading to a substantial $38 billion surge in its cash equivalents, and treasury bills. Steve Hank, a professor of applied economics at Johns Hopkins University, sees Buffett's actions in the second quarter as indicative of an anticipation of a potential recession, coupled with the observation that stocks are currently overpriced. Hank also pointed out that Buffett's moves align with his historical pattern of choosing cash when storm clouds loom on the economy. This approach allows him to be prepared for seizing opportunities when the market presents bargains during challenging times. The cautionary moves made by these seasoned individuals underscore the importance of paying attention to their signals, as their experience and strategic decisions carry weight and insight that shouldn't be dismissed lightly, no matter how rich or poor you are. Steve Hank also has a notable history, having served as the president of Toronto Trust Argentina during its peak performance in 1995 as the world's best performing emerging market mutual fund. Let's not forget that during the 2008 financial crisis, Buffett sealed deals with companies like Goldman Sachs, General Electric, Harley-Davidson, and Mars, showcasing his strategic approach to opportunities in times of economic tough time. On the other hand, Michael Burry's Scion Asset Management recently revealed put options against S&P 500 and NASDAQ 100 index funds totaling $1.6 billion in notional value as of June. While the actual cost of these bearish wagers is a fraction of that figure, it represents a significant bet considering the rest of Burry's portfolio was valued at around $111 million at the time. Burry has a track record of betting against high-profile entities like Elon Musk's Tesla and Cathie Wood's ARK Invest. Steve Hank, who was also a former advisor to President Ronald Reagan, expressed support for Burry's latest move, considering it a wise decision. Hank has previously shared his view that stocks appear expensive compared to bonds, and he also anticipates a recession hitting the U.S. economy in the first half of 2024. These insights from both Hank and Buffett, along with Burry's strategic moves, show us the cautious tone and their assessments of the current economic landscape. Stephen Graham's newsletter, Interesting Take. Elon Musk, the money guru of today, sends out tweets that are like puzzles for people who love watching the stock market. For example, he tweeted something with a missing word, and when people figured out the missing word was tender, it seemed like he might want to buy Twitter. This was the time everybody knew that Musk's tweets can seriously shake up the stock market. Stephen Graham has stated this very clearly in his newsletter on market sentiment. Not just Musk, the Federal Reserve or the money boss in the US also talks in a way that affects the economy. Jerome Powell, the head of the Federal Reserve, recently talked about changing interest rates. The Fed wants to control inflation, which is when prices go up, and people are trying to figure out what their tricky words mean for the economy. This may be just a few words for the one on the higher table, but it terribly messes up the daily lives of people and small investors. The question here is, are the changes in interest rates doing what they're supposed to do for prices? It's a bit tricky because some things are getting less expensive, but others, like car insurance and sports events, are getting more expensive. Like housing prices are going up, which is surprising. But there's hope that if interest rates go down, housing might become more affordable again. As we say goodbye to 2023, the housing prices went up a lot, even though other things didn't. But if interest rates go down soon, things might get better and housing prices could go back to normal. The stock market had a good year in 2023. The future of the stock market depends on something called the 10-year Treasury rate, which is a bit complicated. But if things with inflation and interest rates get better, the stock market might also show some good signs. It's a little deadly dance of assets against inflation, especially in times of recession, but we have to be patient. According to Stephen Graham, people who have a lot of money to invest are waiting to see what happens. They have $5.7 trillion. That's a huge amount, just sitting there idle, ready to be invested when the time is right. But predicting exactly what's going to happen is tough. Some experts guessed right, and others got it wrong when they tried to predict how the stock market would do. The big question is, when will interest rates go down? Jerome Powell from the Federal Reserve hasn't given a clear answer, but people think it might happen around March 2024. It's all a bit uncertain, and Powell wants to be careful because the economy is still a bit shaky. So, what should regular people do with their money in this uncertain time? What should you do now? The best idea is to spread your money around, not just in one place. Investing in stocks, save some bonds, maybe buy a house, and a little bit in things like Bitcoin. This way, no matter what happens, you're ready for both good and not so good times. It's like doing a careful dance between being hopeful and being prepared. In conclusion, Graham's delivered understanding of market dynamics, urging readers to transcend surface level information. So the only thing you should do now is to carefully diversify a portfolio by doing thorough market research. This also includes staying away from the companies that already are doing dry business in the market, especially those who already have a virtual competitor cruising. Any stocks that are on a hype train driven by just public statements. He suggests taking a smart and varied approach, which makes sense given the uncertainty in the financial world right now. The verdict: diversify your portfolio. No matter how complex it is, always make sure to never get caught in the FOMO. That's what the most seasoned investors like Warren Buffett and Michael Burry will tell you. If it's a recession that is about to come or an economic slowdown that is happening, no matter what it is, you have to be aware of everything that happens in the market right now. Stay away from overpriced stocks unless you bought them really low. Wrapping up for today, we genuinely believe this video holds keys to improve your financial game. If it clicked for you, show some love with a thumbs up. And there's more videos on the way, especially on the finance world right now. Subscribe now to unlock a wealth of insights because, spoiler alert, a game-changing video is headed your way soon. Secure your financial journey and stay tuned.